Okay, well, good morning. Thank you for joining us for today's coffee talk. My name is Sean O'Brien, president of QuickRate, and as always, pleased to be joined by Steve Huntington. Steve, you want to go ahead and introduce yourself?
Yeah, good morning. Thanks again, everyone, for coming out on another Friday morning here. My name is Steve Huntington. I'm the Director of Analytics here at QuickRate and QwickAnalytics. I've spent my entire career working with community banks all over the country in everything from strategic planning and valuation to advisory and capital work. And I've been working with Sean here at QuickRate for about 12 years now, I think.
Yeah. And we are thanks, Steve. We are very pleased to welcome back, made his travel cut off in short term, but glad to have our dear friend Paul Allen back with us. Paul, you want to go ahead and introduce yourself?
Well, thank you very much. Pleased to be with you today. Paul Allen. I'm with Salt Marsh, Cleveland, and Gund, and get the honor and the privilege of working with bankers and talking about these interesting times that we're living in, as well as how to implement and get through the CECL process. So, thanks for letting me join you.
Always, Paul. We are delighted to have you. All right. I should have moved this slide a little bit, just a little bit more about Salt Marsh and Paul's firm. Just a reminder, again, you can certainly submit questions in the Q&A box in the chat feature. We'll continue, or we'll monitor those throughout and take those either as they come or at an appropriate break or just at the end of the presentation. We will, again, kind of start off with some polling questions. And so I'm going to go ahead and launch those. I think we only have just a few or four. A lot of them are the same. Again, just trying to kind of see where we are. I guess we have 6 this time, so a few more than normal. But the first one here is, have you seen any increase in your past due loans this year? Is a simple yes or no. And then there's a second one. If yes, what category of loans increased the most? And so we'll just give this 30 seconds or so to respond to. Okay,
John, do you and Steve have a bet on what the answer is here?
I was gonna guess no, but I'm gonna, and it's kind of evenly split here. So we'll share.
I didn't get a chance to answer.
I know. Sorry. We're evenly split. 51% of you haven't seen any increase. 49% have. For those of you who have, we've consumer is the leader, followed by CRE and then residential. So again, thank you for participating. Just a reminder, we will send these results out in our follow-up email with the link to the slides and to the recording. So let me go back to the next question here. Just on loan changes, we've already had that one. Let me get rid of that. Oh, I guess we'll go ahead and it's really the same question. Let me go ahead and get to this next.
That's just an increase in volume of loans, I think.
Yeah.
Oh, yeah. Nope.
Yeah.
Let's launch. You're right. Let's keep that out there. So we'll go ahead and answer this one. I skimmed it too fast here. My apologies. Have your loans increased or decreased this year? Thanks, Paul, for actually reading the question as opposed to me just skimming the question. Right. All right. Now we'll go ahead and end this one. So this is encouraging, I think. Let me share this. 66% of you have seen an increase in your loans this year, 22% decreased, and 13% have stayed about the same. So that's, I think that's encouraging. I know it felt like the last couple of quarters, everybody had kind of moderated some of their loan interest. All right. So let's go to the next one here on the ACL change. Has your allowance for credit losses increased, decreased, or stayed the same this year? I'm gonna end that one and share it. So 51% of you, it's stayed about the same. 36% have seen an increase and 14% have seen a decrease. So thank you again. Next up, do you anticipate increasing your reserve this year? Just a simple yes, no, or undecided on this one. Okay. This one, share. 48% of you said yes, 34% no, and 18% undecided. And let's see, just a couple left here. Unfunded commitments. Do you currently have an amount reserved for unfunded commitments? Just a simple yes or no on this one. This is one we'll talk about here in a little bit in further detail, a little bit of a trend in this particular reserve that we want to kind of highlight and just talk about. So this is actually good. This is more than I would have imagined. So 78% of you do have a reserve in there, and 22% of you don't. So that feels kind of in line with what we're starting to see across the industry. And then a final question on model validation. Has your financial institution had a model validation performed yet? Again, just a simple yes or no on this one. Okay. It's actually more than I would have thought. So 42% of you have, and 58% of you have not. So again, thank you very much for participating in our polling questions. Again, we'll share these with the follow-up email that will likely come out on Monday afternoon or Tuesday morning. And we'll get started a little bit more. Just a reminder, this is really more of a placeholder. We just want to continually update you with improvements that we're making to the tool. Again, most of these are usually optional tools. They don't impact directly the calculations, but just trying to find ways to make the ongoing management and utilization of the tool just more flexible and repeatable. Steve, anything you want to add here on any of these?
Yeah, the one we're going to talk about, the automatic warm imports, in just a second here. That's the one that's brand new, and nobody has seen it yet. The one we've talked about the last couple months, which is the user control and management. But I know we've talked about that the last couple coffee talks. If you want a little walkthrough of that, shoot us a line and we'll send you a video discussing how we've improved the user control and management in a way that gives you a dashboard to see who all your users are and change their level of access and give additional users read-only or full access to the tool, and manage it in a more centralized location. But on the next slide, you'll see, and most of these updates and enhancements have come as a direct result of feedback that we've gotten from all of you. So please keep it coming. If you'll go to the next slide, Sean, we'll see. So we had a lot of users ask us our users that we're calculating the warms for you, which is about half or so.
Yeah, it's right about half.
Yeah, about half of our users were calculating warms for you guys with your loan level data typically on a quarterly basis, plus or minus. And once we finish that process, we hand you the spreadsheet. And you guys have always been in charge of plugging those warm values into the tool so that we're not really, playing with or manipulating your scenarios for you. But we've had a lot of requests for people. Is there a way that we can automatically import the results of the warm calculations directly into the tool? And so that's what we've done here. There's multiple methodologies that can be used for calculating a warm. There's a more conservative methodology where we're just really adjusting for prepayments, which kind of results in relatively high warms or long warms, and all things being equal, higher reserve levels. And then a more, I wouldn't call it aggressive, but a methodology which takes into account amortization as well as prepayments, which brings the warms down some. And we have, as you all know, we've mentioned a few times now, the NCUA did a big study on credit unions around the country and got some really good data that does translate to commercial banks decently well as far with prepayment data and warm calculate or average warm values by loan segment across the financial services industry. So we're now offering that as well as sort of a starting point if you wanted to pre-populate your warms with some industry averages, so to speak. You'll have two options. That's the first one, the regulatory study data. And then also we've aggregated the thousands, actually at this point, hundreds of thousands, we've crossed that threshold, hundreds of thousands of scenarios have been run from our thousands of users on the CECLSolver. And we were able to aggregate and use all that data to show you guys what all of our users are using for their warms on average by segment. And so you can choose either the regulatory NCUA type data for average peer-based warms, or all of our CECLSolver user aggregate averages warms as well. So even if you don't, if you're not having us calculate your warms, if you wanted to get a start on using the tool before you had a chance to go through all your own loan data and calculate your warms, you can use one of those two peer-based approaches. And if you have us calculating your warms, then you can choose the two primary methodologies that we offer for that. And so it's a two-step process. The only thing that you'll notice different on the CECLSolver, there's a green button. There will be starting the week after next. So not next Monday, but the following Monday. There'll be a new green button there at the top of the warm column called pre-populate. You'll click on it, and then you'll choose a methodology, and then you'll choose a date. For all of you who were calculating your warms, as soon as we calculate a new warm for you with your loan data, then there'll be a date in there. If there is a time in history, like the end of last year, that you'd like to have your warms that we calculated for you stuck into the kind of backdated into the tool here, shoot us a line and we can do that for you as well. But this is just a way to kind of simplify the process if we're helping you out with the warms, or give you a couple other options for getting the ball rolling, so to speak, without having to do an entire warm study, so to speak, to get accurate data. Sean,
Hey, but I was wondering if you might just mention for those that haven't had you calculate the warm, how do you, just real roughly, what are the steps for the client, for the bank to get you to calculate the warm?
Sure. So we set up a secure link that you can, using share file, so that you can share your loan level data with us. And what we do is we clean it up and we sort it by call report segments, whether that's done internally or you have mapping to do that with your internal data. And then we apply prepayment assumptions that you can modify or customize, and then amortization assumptions as well that you can modify or customize, and do the calculation at the loan level for each segment. We do it all in an Excel spreadsheet, which is organized by segment. And then there's a summary page there that shows all the segments, all the methodologies, and all the different ways it can be calculated, and any of the major assumptions like prepayment rates and amortization assumptions. And then we kind of send that back to you to do with, to organize and do with as you please. But now that last step in the link in the puzzle between taking that and sticking it into the tool, we've sort of automated that as well, so you won't have to worry about that.
Yeah, and I think, just to reiterate what Steve said, right? I mean, we got this was probably what the #1 request from our banks who were having us, and it is about 50% of our CECL banks have us calculate their warms. And this was really, hey, can't we do something about this? And so we did it. Again, most of you probably think about it standard and enhanced, in terms of how it looked on the spreadsheet. We'll be adjusting it to make sure it all looks consistent. The peer-based ones, again, just more optionality for you. Doesn't need to be incorporated, but as Steve said, if you're looking for, one of the questions we do get is, what are other banks doing? What are their warms? This just gives you a way to kind of see, both on a couple of different peer-based ways to see other approaches. And so again, it's just really all designed to, one, make your interaction a little bit more seamless, and two, excuse me, just give you a little bit more peer and context information around it. So we got a chat in here real quick. Let me just pull this up. Oh, it's actually, and there is a charge for the mapping. We do, there is an additional fee for that if we map your warms, but again, just an additional service. All right, let's see. We have another question to the chat. We have historical net recoveries for some of our larger pools of loans, which lowers the required reserve. Changing the look back does not help. This trend also exists in pure data. We would like the model to assume that net recoveries equal a historical rate of 0. Have you considered this as an option rather than adjusting the Q factors? So the answer is we have talked a lot about it. We considered making it a 0, but Steve and I, in discussing this, really felt like we wanted to always show what your experience actually was. And so if we manipulated it and made it a 0, we felt like that was less transparent, because the reality is you are in net recovery. And so we decided the better option was to adjust it in the Q factors, because the likelihood is you won't be in net recovery forever. And so it feels like a change that should be adjusted as opposed to us changing the data. Steve, you want to jump in?
Yeah, we thought it was a pure approach to not to as a general rule, never to modify the actual filed publicly available historical data directly. And because some banks are changing look back periods, and then some banks each quarter, if an old quarter rolls off a look back period, some of those negatives become positives and they kind of bounce back and forth. But the concept, conceptually, of a qualitative factor adjustment is any reason why current and future conditions may be different from your actual lived historical experience. And if your lived historical experience over the last 18 months was net recoveries, you should be identifying that fact and discussing why it's going to be different, i.e. not negative, continuing going forward. If you just make an automated adjustment to make it 0, you run the risk of ignoring part of your charge-off and recovery trend historically that you need to modify correctly through Q factors. So we thought it was just a little bit cleaner to not do that. And then if we were to be zeroing out historical ones, then there's methodological questions. Do we zero it out for each period? Do we zero it out for each year? Do we zero it out only for the lifetime historical and leave the historical individual years as negative? And then how do you get to, so there's more mathematical questions and everything else. And so I think from an Paul can would like to hear his thoughts on it, but from an accounting standpoint, I don't like sticking in assumptions, I guess subjective assumptions about when and how I'm going to actually modify historical factual data in a tool like this.
Yeah, and that's been generally the discussion about this issue. Is what happens in a particular period of time or a particular category where your recoveries actually wipe out some of the historical losses or offset historical losses. And this discussion about, well, let's set the bar at 0 for anything that would cause me to go below 0 on charge-offs. And the dilemma has consistently been that when an auditor or an examiner is testing your actual period, your actual experience, they want a clear audit trail. They don't, there's a general bias that the actual data is the actual data. And like you said, Steve, if you're going to consider that you don't believe that data will be repeated, you do that in an adjustment. Another one of the audit or exam issues was that there was a tendency to only treat the recoveries that were big enough to go to 0, but small amounts were not treated the same way. So there was a difference in the way that you dealt with recoveries when you sort of selected 1 or 2 recoveries to wipe to 0. And so it became a little bit arbitrary about what you're doing. So I think the best practice, if you will, is that you use actual charge off or recovery experience for the period of time you're using and so forth. And if you bring that forward and management feels like the historical loss experience is not repeatable, then you would make a qualitative adjustment for that. So those are a lot of words to say, Steve. I agree with you. I think that the best practice is to leave the actual data alone. And if you believe that the actual data is not reflective of what you're going to experience, you make that in an adjustment.
Thank you, Amy, for that follow-up comment as well. And then I would just say too, the other thing I've had banks do in this similar situation is, I know you mentioned you changed the look back period. We've even extended it again. Going all the way back to 2008, still bringing it back to the current WARM, which our tool allows you to do. But that sometimes is another alternative to just incorporate all the historical information that you have, and then that sometimes brings back a more presentable and realistic expectation for historicals.
That follow-up, the follow-up feedback there is helpful, and it illustrates a point that the examiners and the auditors are not necessarily always on the same exact page, especially when it comes to CECL. CECL is something that was driven, as we all know, by FASB and not by the bank regulators, and so they are going to have a little bit of a difference of opinion sometimes as to how you get from A to B to C, and what assumptions they think are more get you to the point where they think you should be, either properly or reverse engineering wise. But the accountants I think we're on board with that that thought process more, because they're typically the harder. Go ahead.
I was just going to say, can I add, we're not talking about the auditors or examiners disagreeing with the concept of offsetting recoveries. It's just a question of, do you do that in your actual data, or do you do that as an adjustment? So I think auditors and examiners would all be fine with you saying, I don't think these recoveries are going to be repeatable. It's just a question of whether you do that directly on the historical data itself, or you do it through an adjustment.
Yeah, data integrity, I think, is kind of what won out in our in our discussion. Like you said, leaving that intact and with as much integrity as we can and transparency is we think the right way to do it. Again, for those of you not following the chat, thank you, Mustafa, for putting in your comments, treating it as zero, or is it instead of a negative loss, and the examiners were okay with that as well. So the next discussion, we're fortunate to have Paul on with us, and again, he is obviously speaking to banks on a daily basis, and some of you may have heard our conversations pre-start of the webinar today, just talking about some of the first quarter numbers and some of maybe the interesting cross currents that seem to be occurring. So we were just going to have Paul talk a little bit about what he's seen, about planning for potential change and how we might address that in CECL. And so at this point, I'm going to turn it over to you, Paul.
Well, Sean, I just wanted to mention that we're probably all tired of hearing for the last couple of years that we're imminently going to move into a recession. Discussion about whether we'll have a soft landing or a hard landing, and the feeling, I guess, that there's a general consensus that asset quality is going to turn downward, or our credit cycle is going to turn down. And so we've been talking about that quite a bit, and there's been an expectation. But so far, before late into last year, the credit metrics just haven't deteriorated. So the charge-offs we saw continued to be in the consumer section and auto loans and credit cards, with very little deterioration in CRE, C&I, and some of the more traditional portfolios. However, that is changing. And so in the fourth quarter, we saw the beginning of some increase in non-accrual and in delinquencies and so forth in the rest of the portfolio, and that has continued in the first quarter. This week, the FDIC released the first quarter earnings release for the industry. And I encourage you to read beyond the first paragraph, because first paragraph talks about, that we had a great quarter, 66 plus billion for the industry. Certainly a significantly better quarter than the prior quarter. However, when you read on, you'll see that the prior quarter had some one-time assessments and other things in it. So that wasn't in the first quarter. So first quarter was obviously a little bit better. But the asset quality metrics, particularly in CRE, in large urban markets, admittedly, mostly there, but not all, C&I. So in the rest of the portfolio, we are seeing some deterioration in things like office buildings and some of the other acquisition and development type commercial lending. We're starting to see in public bank earnings statements some comments about concerns about some of the credits. If you're a bank that does large commercial real estate projects and they're in a construction phase, those construction projects are being delayed, and it takes longer to stabilize those to a normal stabilization if it's income producing property. So we're starting to see all of the things that we normally would associate with a downturn in credit quality. So probably important to be watching that, because right now our ACL is comprised mostly of qualitative factors, and we're all kind of used to that, have been that way for a little while. So, the thought process, how can you be prepared when in fact we start to see a change? And certainly if you listen to the regulatory comments from the agency and public earnings and other statements publicly, the media coverage is that is changing. So on that, on the next slide, just a general comment: how do we deal with that? Some of the comments that are concerns have to do with the size of the federal deficit and the impact that has on our domestic economy. We're in the longest period of time that we've been in an inverted yield curve in American history. So this is a very significant time. There's certainly some things to think about. And so there's an expectation that the management group will be prepared and ready and having live discussions about what to do. And so that naturally leads us into the conversations we just had. We're probably going to see more of the ACL coming from historical charge-offs and a little bit less from qualitative. And quite honestly, that may be a little surprising or shocking to some of your board members or management. There's sort of this feeling that once you set the qualitative factors, those are frozen. You can never reduce those. But in practice, we've all talked about, hey, when you start having charge-offs, you're going to shift. More of the reserves going to go into the historical area. And accordingly, since you've already had that loss that you expected before, then your qualitative factors would theoretically be released some. So that warrants some thoughtful discussion among your management team and your board to set expectations. It's probably going to change your narratives that go along with the quarterly run of CECL that sort of support and talk about that. And I would expect that there would be a change in your management committee meetings and board meetings as you discuss that fact and you get ready for that. So I would encourage you to be watching that carefully and to already start thinking about and talking about what will this do to the quarterly run of our CECL? What would we expect it to do? And let's see if it's actually happening that way. I would also probably be watching my peer because, Sean, I think all your clients are the best banks and they have all the best portfolios, but you're probably competing with, worse competitors. So those factors may show up in peer data, all those other banks, but regulators and analysts are going to expect that whatever happens to the peers is going to happen to you. So I would be probably discussing what you see in public banks and your peers, even if it doesn't show up in your data yet. Have that conversation and have that preparation, because certainly your audit and exam teams are going to be looking at that data and expecting you to be talking about that and thinking about that. Does that make sense, Sean?
Absolutely. Yeah, I think it's the hardest thing, that we have to do is, for many of us, when we haven't had losses and we are relying on those Q factors, just trying to consistently have a framework to communicate what we're feeling, what we're seeing, what we're expecting, what we're doing. And, I think it's a never ending process, but I think, as you pointed out, right, despite the fact that we've been talking about it for a couple of years and some of the, everything really to this quarter has still been pretty clean. It's hard to want to adjust those, but it just feels like pulling things out right now and not having some expectation of maybe some stress ahead, feels maybe like we're not capturing the whole picture. We had an interesting question. This was really a good question. I'm not sure I have a really good answer off the top of my head, but we'll leave it to Steve and Paul and see what they come up with. We've received some pushback from auditors about how much of our ACL is comprised of Q factors, but how else can we justify our ACL when we have little loss history? Is there a good set of metrics that we could refer to as a part of our forecast of economic risk? So this really kind of captures, I think, one of the dilemmas that a lot of our banks have. Steve and Paul, I'll throw it to you guys. I'm not sure how I want to answer that one.
Yeah, I'll give some general thoughts. But I think, oh, hold on.
Did I just
I wanted to keep looking at it as I was
gotcha. Sorry.
thinking about it. That's all right. Well, I mean, there's only two spots that your reserve can come from. It can come from the historical, or it can come from how you think the future is going to be different than historical, right? So if you have an auditor who's uncomfortable with what percentage of your reserve is coming from Q factors, they are then that would suggest that they're uncomfortable with how high your reserve is, which is kind of an odd thing to say, because as we talked about earlier, history is what history is, and the only way to modify the history is through a subjective choice as to what look back period to be using. So if you're not getting any reserves from any losses over the last 3 or 4 years, and you've got 100% of your reserve as Q factors, and I assume that your auditor is not suggesting that your reserve is too high, just the kind of where it's coming from, then the only way that can be changed is modulated, is to look back and find a period of history where you had higher losses, and then justify why that is an appropriate period of time to be including into the historical part of it. And that's certainly very doable. If we go way back to the last recession and you include some losses from 2011, 12, 13 or whatnot, as long as your institution had a similar business model, similar size, similar loan portfolio construction, I could see an institution making an argument that, listen, our losses from back in the last recession are still relevant. They're still a part of our long-term history. And then if you were to do that and make that argument, that would take some of the burden off of the Q factors, because your Q factors would necessarily be lower. If you think about it, if your Q factors are saying, we think the economy is going to be a lot worse 2 years from now than it is right now, therefore we're jacking up our Q factors. However, if your history is going all the way back to and including part of a great recession, then that Q factor adjustment is, well, it's not going to be that much different from history, because we're taking into account as part of our history part of the last great recession. But that's kind of my thoughts on it. Paul?
Well, I guess if I got that feedback from the auditor, the first thing I'd probably do is just sit down with them and say, tell me exactly what you mean and what your concerns are, because if the auditor is really sensing that your look back period is wrong, then that's a discussion that you can have. You can, There are two ways of looking at this in our industry. One is use the longest look back period you can possibly do to capture all of history. But as Steve mentioned, your portfolio changes over time, so your current portfolio may not look anything like the underwriting standards may have changed and so forth. So there's arguments for and against that. The argument for is gather as much information as you possibly can have, use the longest look back period. The counter to that is your underwriting has changed. The portfolio factually has changed in composition. So therefore, let's look back to the period of time that is reflective of my current portfolio. So there's two ways of looking at that, but I'm assuming the auditors are smart and brilliant and fully understand CECL. So there's not really a way of saying under CECL, there should be a certain amount historical loss and a certain amount qualitative, because over time that constantly changes depending on what cycle you're through and so forth. So I would just ask the question, I'd say, are you really saying that, are you uncomfortable with my look back period? Some people use a very long period of time. Some people use approximately their weighted average, their WARM. In other words, say if I have about 7 years average life, I'm going to look back about 7 years. And that has pros and cons, because it may, for all the same reasons, that may not be reflective. So the first thing is I would ask for clarity in that question. What are you really concerned with? Secondly, I would consider my circumstances. If I'm a de novo bank, it doesn't matter what look back period we have, because we haven't been in existence that long, right? So for a bank that has a relatively short history, we've already seen the regulators and others say you should use peer data. So then the question is, are you saying that I should use not my historical, but peer data? And if so, please help me understand who's an appropriate peer group. And secondly, what is the look back period that I should be using for that? So I would ask more questions about the auditor. I am not aware, Sean or Steve, of any place where one would say there is a best practice metric that 2/3 should come historical, 1/3 qualitative, or vice versa. In our industry, I would venture to say probably 80 or 90% of our industry reserves are qualitative. There's just not that much out there for historical, unless you're a very large bank with a retail portfolio, credit cards, auto loans, things like that we've had losses recently, or you're using a look back period that goes all the way back into 2005 or so, where it captures the 2008, 9, and 10. But that's a long period of time to look back. So underwriting standards have changed. Lots of things have changed. So I'm not sure how to answer the question. I'm the dumbest guy in the room sometimes. If the auditor asked me that, I would sit down and go, please explain what you mean, what your concerns are. I'm all ears. I'd love to have a conversation about it, but I don't know how to answer it in the abstract, if you will.
Yeah, and I think to your point, Paul, the other question I'd probably ask, and I think is what's different now than say a year or two ago? Because I suspect if your reserve hasn't changed dramatically pre-CECL versus the ALLL, and you were probably substantiating much of your reserve with qualitative factors even then, what's different?
Yeah, that's what I was going to ask. Has the auditor changed, or has their tune changed just because of CECL? And if you've had little loss history over the last decade, how were they comfortable with it 3 years ago and now suddenly not? When conceptually it hasn't changed.
Yeah.
And one thing you should always use as stepping back is, however you got there, historical loss or otherwise, how is your reserve to loan compared to peer, and how does that look when you know what you know about the bank and your portfolio? In other words, are you a more aggressive, a little bit riskier underwriting standards in general, then you would expect to have a higher loan reserve than your peer group. And conversely, if you're more conservative, which may be being proven out by the lack of charge-offs, then maybe you should be fine with where a peer is. So I would just consider these issues holistically rather than try to come up with a particular metric.
Yeah. Another question came in. We have questions on the scale/percentage adjustment for each Q factor. Is there a standard or target for each positive or negative adjustment? Again, I don't think there's necessarily a standard or a target. I think it's really, part of you identifying and establishing a repeatable process that you feel good about. Like I know in our matrix, we give you the ability to kind of set your highs and lows so that you can have something. I'll pass it to you, Paul and Steve. I mean, I don't think there's a necessarily.
Yeah, I mean, it's a frame. The Excel file that we offer just provides a framework, but all the decisions within that framework are completely subjective. Is moderately more risk mean 10 basis points, 30 basis points, or 50 basis points? And there's no answer. There's no one answer to that question. But as far as to give it a framework, all the qualitative, the way our tool is set up, all the qualitative factor adjustments are adjustments to the historical lifetime loss rate. So if you have let's say you have a WARM of 5 years for your mortgage portfolio, and you have a historical loss rate of 1%, a Q factor adjustment of 25 basis points for a particular adjustment is 25 basis points off of the 1% historical, right? So it's relative to, say, over the last 5 years, I've had total losses of 1%. So over the next 5 years, I expect to have 25 basis points less than that. So it's relative, the Q factor adjustments from a duration and time standpoint are the same size buckets, the same duration buckets as the historical. So it's relative to changes to the historical. So don't think of it as, I think a pitfall some people fall into is, all right, I have a lifetime historical loss rate of 1%. Now I'm going to think about my Q factors in annual buckets going forward. The Q factor adjustment is a lifetime bucket, just like the historical starting point is a lifetime duration bucket. I hope that helps.
Yeah, and you said to reduce it, but obviously the adjustment could go either way. It could either it could increase or reduce that. Absolutely.
Yeah.
Absolutely.
And there's nothing wrong with having negative qualitative factor adjustments depending upon what your history has been, and that will creep up as you have as institutions have unexpected significant charge-offs or even expected significant charge-offs in their portfolio in any given quarter. That could have an outsized effect on the entire historical lifetime loss rate. Because if most of us have zeros in any given segment for a period of time, then all of a sudden you've got an annualized 75 basis point or 1% or plus loss in a segment, then all of a sudden the entire historical rate bumps up, even though for most of those periods it was zero. So then that's when you want to think in your Q factor adjustments, well, listen, half of my Q factor adjustment was the expectation that this credit might have some problems. And now it's gone bad. And I think Paul already alluded to this earlier. So now I'm shifting that burden, right, from the Q factor to the historical. So the historical went up, but the Q factor is necessarily going to go down as long as there was some expectation of that loss in your previous Q factor adjustment.
Yeah.
And I do want to give some kudos to what y'all are doing in terms of showing some averages for different Q factors and so forth, because keep in mind the industry has only been in CECL really for 23 and 24. We don't have a long historical period of time. You certainly could look at the public banks, but the bulk of our industry, the bulk of our data is relatively new. And so, examiners and auditors don't have a lot of, historical reference points for what should the qualitative adjustment be in a period like 2008 or 9. What should those adjustments be when we're coming out of that period? I mean, obviously, when we came out of 2008, 9, and 10, where we had large historical. Our qualitatives coming out of that when the economy recovers those are likely to be negative. As we're going into this economic downturn without historical losses yet, the qualitative adjustments are probably going to be positive. So it fluctuates over economic cycles, and we haven't had a lot of economic cycles yet. So it is a little difficult, and I feel for the CFOs, because it's kind of hard to really say, yeah, I feel really great about this qualitative adjustment based on the last 15 years of data. Well, we don't have 15 years of data to look at. So you're going to have to be a little bit thoughtful in how you discuss and your narratives on that. But on the other hand, there is no bright line right answer. So, you have the opportunity to use your best judgment on the risk profile of your portfolio.
Absolutely.
Points for paper here. It's less critical to your typical examiner, whether that's 5 or 10 basis point adjustment, and more critical as to your thought process as to why you chose 5 or 10.
That's exactly right.
And that's why in the tool, we've made sure any place where we could possibly add spots for you to make notes about what your thought process was at that point at that period of time, we've done so. And we've added the notes functions to the different segments in almost every part of the tool now, and they all save with the scenario. So that gives a great paper trail for 6 months from now when you're getting questioned about a particular assumption or adjustment that you made last year or whenever. You can go right back if you made diligent notes and see, all right, this is the thought process for this segment at this point in time, and this is how it's changed over time since then.
Yep. Thank you, Barry, for the notes in the chat and the kind words. Same to you, Cindy and Amy. Appreciate the sharing those comments in the chat. All right, so we'll move on here. So let's see. Oops, let me get these things closed.
I think we
covered all this.
The next one is just some bullet points. Just again, just be thoughtful and careful. So
yep,
I think we've covered those.
Great. The next couple of slides are some Steve has worked diligently on just putting together and aggregating some of the data from our users, from the industry. And so he's put together, I think some interesting slides here for you. So Steve, I'll let you talk about these.
All right. I appreciate leaving some time for the data.
Yes.
Excellent. So you guys have seen this. There's some stuff in a couple minutes that nobody has seen yet, which I think you'll find very interesting. But this is just a reminder, now that all the 1Q stuff is completely finalized and well behind us. Just wanted to highlight, you've seen, this is sort of an overlay, an aggregation of over 75,000 at the time, segment level user scenarios that have been run using the CECLSolver tool. So this is not the average for the entire community banking industry. It's the average for all of our users, because this is not publicly available data, right? These are WARMs and Q factors. The ACL at the segment level is also not is proprietary for us. So we thought sharing this data with you, once we had enough users to feel like it was a great sample size and indicative of typical community banks around the country, that could be really helpful. And so that's what we're doing here, and we'll keep updating this every quarter. The only thing that's different about this from when everyone last saw it, I put some boxes on the column there, and I just wanted to highlight the segments that currently have the highest levels of reserves for community banks using our tool and around the country. And those are, unsurprisingly, credit card loans bumped up significantly in the first quarter of 2024. Reserves on credit card portfolios doubled. And C&I loans didn't increase, but they've been high. They've been over 1% for the last year. And this, keep in mind, these are also, these are ACL levels on the collectively assessed portfolio. The individually assessed loans are kind of their own bucket from a percentage standpoint for your pooled loans, right? Which is the vast majority, which would be over 90% of your reserve is likely coming from a lot of this here. But you're, relatively speaking, credit card loans are the highest, C&I loans behind them, and we also, and non-farm, non-residential at just under 1%. And then your typical mortgage, your first liens at just under 90 basis points. Where on the other side of the spectrum, leases at only 31 basis points, and 1 to 4 family resi construction right now, and revolving 1 to 4 family are in the 60s as far as reserve standpoint. And these are, again, median values for our hundreds of users and thousands of scenarios for the ACL, the collectively assessed ACL to the loan portfolio. Let's
just to point out, I mean,
Go ahead.
again, what Paul said earlier, right? I mean, so if you go year over year, at the median, everybody's essentially the same, right? Our reserve hasn't moved, and despite the fact that I think even from the polling questions, about half of us think things are probably, probably see some increases in the second half, but again, just kind of where we've been, where we're going, year over year, we didn't see at the median reserves move for most institutions.
Yeah, so these are, so the next slide will show at the more higher level. This is on the left-hand side, total ACL to loans, which includes not only the collectively assessed stuff, but also the individually assessed loans. So you can see those values are about 10 basis points higher, right? The collectively assessed ones were around 1% for the whole portfolio. The total with the individually assessed is about between 110 and 115, and that's not changing, has not changed very much. 25th and 75th percentile have also stayed about the same. So your general range of total reserves for community banks over the last year has been pretty flatlined. Unfunded commitments, we're going to talk about in a little bit higher level of detail than we have in the past on our next slide. But that is typically in the 10 to 15 basis points median. But that's not the most helpful number. And let's talk about that right now. So let's go to the next slide, because that 10 to 15, yeah, here we go. So this is for all the community banks in the United States. So 4,300 plus or minus community banks in the entire United States. If we track just your reserve on your unfunded commitments as a percentage of your total unfunded commitments, right? For the entire industry, it has gone from zero median value of 0.00 about a year ago, and has slowly bumped its way up to 8 basis points in the first quarter of this year. However, about half of the community banks in the country still don't have any reserve for the unfunded commitments on their call report, on the balance sheet, 0. That percentage is declining. A year ago, about almost 60% of the banks, of the community banks in the country, had no reserve for unfunded. That has dropped to 42% in the first quarter. So the increase that we're seeing in reserves for unfunded commitments is not coming from institutions increasing their reserve like from A to B. It's coming from institutions going from not having any reserve to having some level of reserve. Once we back out all the banks that have 0 reserve, all the banks, all the 40 to 50% of banks that do have a reserve, look at that. It's been it's been almost exactly 30 basis points every single quarter. So so what that means is if you're a bank and you're calculating a reserve for unfunded commitments that's not 0 and putting it on there, on average, they've been doing about the same level over the last year. But the number of institutions that are filling out something other than 0 is increasing. So I thought is that what you expected to see, Paul? That's a great way to
put it. That's exactly what's going on, and it's the layout of how you put that there, because we generally were looking at the weighted average or the median for everybody, and that was really a bit distorted because of what you said. A lot of banks just got their CECL implementation and they just ignored unfunded. To be honest, they said it was immaterial. We're not going to do it. And so now that is increasingly kind of not being the best practice, I suppose. People are saying you ought to have something there. And so having just the median for people that have a recorded reserve, that's a perfect analysis there. So thank you very much for doing that, Steve.
Yeah, I thought
that's
that
very
was
helpful.
neat. I was expecting it to be, one would expect typically that the reserve for unfunded commitments as a percentage of total unfunded commitments should fall in somewhat lockstep as your overall general reserve trend, right? If your reserves are increasing, you see more risk. You would also see more risk in your unfunded commitments by the same token. And if one's flat, you'd expect the other to be flat, but I didn't know it'd be so perfectly flat. So that's, and it's a lot of data. We're talking about 4,300 institutions that we pulled this for. So it's pretty, there's a very small margin of error with that large of a sample size. And that's why we use medians, right? Averages are more additive. Medians, sometimes you try to do the math and the numbers don't really add up, but averages, even a trimmed average can be overly impacted by outliers. And that's why we use medians in a lot of this data. Next slide is also brand new, something we haven't seen or discussed before.
And Steve, before we go to that, I
Yes.
just want to make about the unfunded. And one of the reasons we showed that too is, I will say again, in my recent conversations with banks, right, this is becoming an increasingly larger topic, because I understand, like many of you, right, many of you, and Paul mentioned it, feel like this is immaterial and there's really no risk in that unfunded portfolio. But what we've clearly seen over the last year is having zero does make you, I don't want to say a target, but you're clearly going to be asked to justify why it's zero. And it feels like, the expectation is to have something in there. And so really that's what we wanted to kind of demonstrate, is that I think if we look at this, and we'll look at this a year from now, right, that percentage who have zero is going to continue to drop. And we're going to settle in, between 10 and 30 basis points probably for the industry. And so just know you are perfectly fine to have zero, but you should not be surprised if you are asked about it and then expected to have something there
Get some pushback
in the future. Yeah. So anyway, so go ahead, Steve.
Yeah, so I wanted to take a stab at just any regional differences around the country. And there is some argument back and forth about some particular states and what region they fall into. So please don't yell at me if your state is a different color than you anticipate. I grabbed that map. It seemed relatively accurate, so I stuck it in there. But I wanted to track those trends over time. This is just for all the community banks in the country, total reserve to total loans, right? ACL on the loan portfolio to total loans. And what we see is they've all stayed, a 2 or 3 basis point drop in median reserves around the country over the last year. And that's what we've seen on the previous slides and everything else. But regionally speaking, highest in the West, and a significant drop or lower just in the Northeast in particular. Sorry, my colors I realize on my chart don't match the colors on the map there that I grabbed from somewhere. I'll fix that so it's less confusing. So don't look at the colors. But yeah, there's not that huge of a difference between the other regions, but the Northeast part of the country, from Maine down to and including, I believe, Maryland in this particular map, although I might argue that, is significantly lower.
Yeah. And it's been that way, for a number of years. And so again, we just thought, trying to, again, allow you to see yourselves in another different way, potentially. I thought this would be a really helpful slide.
Yeah, and it might be interesting because the way as an analyst, I've looked at the regions a little bit differently. I've always kind of looked at the Mid-Atlantic as being separate from the deep Southeast or from the New England area. If I were to bifurcate that out, I would expect to see another line sort of in the middle, right, between some of the deeper southern states and the farther northern states, in that Virginia, kind of Maryland type area.
But I also think, again, we talk a lot about pure data. Obviously, the three of us are big believers in pure data, and so again, a lot of these questions about where our level should be and just that, right? Always having a sense of where your peer values are and how you relate to those, I think is always important, because again, whether it's an auditor and more importantly, if it's a regulator, they're looking at peer data. And so just to be mindful of different peer levels, I think is always going to be a benefit to you and just helpful in understanding when someone asks you a question about this.
And I can just quickly go through the last couple slides here after this one. This is we had shared some of this last month, but it was very preliminary, as less than 20% of the banks in the country had filed their call reports. Now that everyone has filed their call reports, that 331 column is complete and comprehensive. It's not much different than it looked last month. The trends are the same. So this is where we're starting to see some cracks in that armor of asset quality, right? The first place where we can see that in the public record is in 30 to 89 days past due. That's the first time a credit issue is going to hit the call report. And so we started tracking that by with these segments, and the little trend line on the right there, the red dot shows the highest point in the last year. And you can see a lot of those red dots are all the way on the right. And so we're seeing a trickle up and a jump up in some cases in past dues, depending upon the segment. And the next slide is non-accrual. So that's kind of as that credit's working its way through the asset quality bucket, so to speak. Non-accrual, we see total non-farm, non-residential has seen a clear-cut increasing trend over the last year and a quarter, and C&I has as well. Consumer, and just keep in mind, some of these are not relatively, it's interesting, honestly, because some loan types are more likely to be ones that you keep on non-accrual for a long period of time. And some loan types are ones where you're just going to go ahead and it might be past due, and then it might just jump right to charged off. I mean, we used to, as an industry, have a lot of 90+ days and still accruing. That was a big bucket on asset quality for many, many years. And that's sort of gone the way of the dodo. Most institutions just aren't utilizing the 90 days and still accruing on the call reports like they used to. It's another can of worms I probably don't want to get into right now, but interesting conceptually. Anyway, thought that was helpful. And then finally,
I put something here too. Again, going back to Q factors, right? Sometimes it's hard to be overly precise, but on these calls and certainly on other calls, you've probably heard me talk about just being directionally accurate, right? And I think charts like these can help you substantiate, being directionally accurate, right? Again, this may not be directly applicable to you yet, but if you're sensing, again, if you're looking out and the rest of the industry is seeing this, right, it would not be unreasonable for you to adjust a Q factor because there's a clear trend occurring in particular segments where you may want to be more cautious. Again, you don't have to, but just understanding directionally what, where a trend is potentially moving, is insightful, right? It's informative about how maybe we're viewing the coming months.
And then finally, the end of the cycle is gross charge-offs. So this is not net charge-offs, right? We're looking for like leading indicators or trends suggesting what direction credit quality is going. And obviously recoveries are going to be on the back end. And so there's a whole different dynamic in the interplay between charge-offs and recoveries throughout a cycle. But I wanted to look just at gross charge-offs. And we can certainly see in C&I and consumer loans an increase. Now, charge-offs also have a cyclical component throughout the year, right? Charge-offs always tend to be on a quarterly basis, higher at the end of a year and lower at the beginning of a year. So in my opinion, the better way to look at this is to compare the first quarter of this year, not to the fourth quarter of last year, because it's guaranteed to be lower almost always, but to the first quarter of last year. So C&I, 38 basis points in the first quarter, way down from last quarter, but up from first quarter of 2023. Same thing with consumer loans.
Yep. All right. Paul, I didn't know if you had anything you wanted to add on these last couple of slides. We kind of moved through them pretty quickly. Anything you want to add?
No, I think that's good information, and I would encourage folks to be using that in their conversations with the board and management at least once a year. It would be best practice to go over your assumptions and compare those to peer. In this case, we can see the averages, the median assumptions of others, and to kind of reconcile what that difference is. I got distracted there, Sean, by looking at the ACL reserve ratio at 121 to 125, and was kind of thinking back, well, where was that? You know, when we went into 2020 and then at the beginning of 2023, and you know, it's just kind of remarkable that the long discussed and awaited huge increase in our reserve levels because of CECL has certainly not panned out. So
Old
our
habits die
industry is
hard,
about
Paul.
a 120, you know, 1 to 125 reserve ratio. And I can just go back and remember conversations about it'll go up at least to 2 to 2.5 will be normal. So it's been a surprising, a little bit bumpy ride as we went from the initial discussions of CECL to actual implementation. So
Yeah,
And you can
absolutely.
jump back 15 years before that, and you're going to see around 125.
Yeah, exactly. Exactly. Just a reminder, you know, Paul is certainly available for, you know, questions, but certainly, if you want a validation, you know, now recognize they're busy, so it'd probably be later on before they can get you scheduled, but I thought I'd give Paul a plug here since he is familiar with our
thank you,
tool.
Sean. But there are a number of really great firms out there that provide outsourced internal audits, and please, you know, please feel free to use everyone. We'd love to help if we can, and thank you for the plug. But there are, you know, we certainly want to acknowledge we're not the only firm that does model validation.
So we shouldn't have put 2 weeks guaranteed in the on the last slide.
Okay, so moving right along to the chat.
Tony,
or
thank
questions
you for the
or something.
Yeah, Tony, thank you for the comment in the chat about validation. So it's good to hear a few comments or changes from your validations. Just a reminder, we're putting more information out on YouTube. Some of the slides that Steve showed today, we'll probably tag those in the resource button on CECL. Don't you think, Steve? You'll drop those out there.
Yeah, I think, and we're in the process of, as you've probably seen, if you've clicked on our newer knowledge base button, which is a more centralized organization for all of our, all the ways that we can support you in using the CECLSolver tool, where that's sort of step one in getting the resources to you where and when you need them. We're going to be adding more little videos and helpful tutorials and whatnot throughout the CECL tool, CECLSolver tool, visually when you encounter an issue on unfunded commitments. There'll be a little video or tutorial right there on that page that can help you with that topic. And so that's an ongoing process. But so if you hear some of this again at some point by clicking on one of those, that's what happened.
Yeah, but we will put those slides on the knowledge base. Just a reminder, for those of you who want to dig a little bit even deeper into your loan portfolio, we are offering 6-month free trials on our portfolio analyzer offered through IntelliCredit. Certainly encourage you to learn more. We are doing bi-monthly coffee talks, or I guess every 2 months, coffee talks on IntelliCredit and just loan data. So certainly look out for those. You can see the upcoming events. We'll be back here in June for another coffee talk for CECL, and then that next loan data coffee talk will be the 12th of July. So certainly encourage you to join that one. We've got a lot of new interesting tools that we're building there, and we'll be happy to discuss those. Again, thank you all very much for attending today. Thank you for the questions and the comments. Paul or Steve, any final comments before we let everybody get back to their day and weekend?
Nope, not for me.
Right.
Enjoyed the conversation. Thank you.
Thank you, as always, and thanks to all of you for joining us. And we'll see you next month. Thanks so much, and have a great weekend.
Thanks, everybody.